What if the real threat isn't hackers? It's us. And when banks pour millions into AI to fix that, the results are shocking. The truth about where risk really hides will surprise you. Let's find out.
What is the truth about operational risk, the Basel framework, and the harsh reality facing modern banks? Behind the glass facades of global finance, a silent killer is quietly draining billions, entirely unnoticed by the public.
We assume financial giants are toppled by sudden market crashes, massive credit defaults, or brilliant cybercriminals. But the real threat isn't a mastermind in a dark hoodie. It's something far more mundane, deeply embedded in the daily grind of the banking machine. If it is not market volatility or credit defaults, what exactly is sinking these massive institutions? How do international regulators actually classify this invisible drain on capital?
The Basel Committee officially defines operational risk as the risk of loss resulting from inadequate or failed internal processes, people, and systems, or from external events. It is a broad umbrella that captures everything from a broken server to a dishonest employee.
Surely the greatest danger comes from the outside, from malicious actors, natural disasters, or coordinated attacks trying to break into the vault.
Surprisingly, no. A Federal Reserve study found that 78% of operational losses at large U.S. banks, totaling a staggering $180 billion, were caused by internal practices. The call is quite literally coming from inside the house.
How can highly trained, exceptionally well-paid professionals inside a bank cause more financial devastation than a coordinated syndicate of international hackers?
It often comes down to the infamous fat finger error. Despite advanced degrees and rigorous training, humans get tired, distracted, and overwhelmed. A single misplaced decimal point or a misunderstood keystroke can trigger an unstoppable chain reaction of financial ruin. Just how expensive can a single clerical typo really be in the modern, heavily regulated financial system? Surely there are safety nets to catch an extra zero. Those safety nets frequently fail. In 2024, a simple administrative overissuance of securities, a clerical error in tracking what had been registered versus what was sold, cost Barclays an astonishing $1.5 billion. A mundane paperwork glitch wiped out a fortune. Is it just individual carelessness, or are the internal processes and software interfaces used by these mega banks fundamentally broken by design? Process failures are rampant. In August 2020, a confusing, outdated software interface caused Citibank subcontractors to accidentally wire $900 million of the bank's own money to the wrong creditors. A clunky menu screen literally authorized a near-billion-dollar mistake.
If a confusing software interface can accidentally authorize a massive wire transfer, what happens when the automated high-frequency systems themselves suffer a catastrophic failure? This is the terrifying reality of systems risk. When algorithms operate at the speed of light, an unchecked software bug doesn't just make one bad trade, it makes thousands per second, turning a minor glitch into an existential threat.
How quickly can a simple system glitch drain a company's capital before anyone even realizes what is happening on the trading floor? On August 1st, 2012, Knight Capital Group lost $460 million in just 45 minutes. That is over $10 million vanishing every single minute. Because a technician simply forgot to update a single older server during a deployment. If algorithmic trading can destroy a firm in minutes, what happens when consumer banking systems, the very platforms everyday people rely on to buy food and pay rent, suffer an IT meltdown?
In April 2018, TSB Bank attempted a massive IT migration to a new platform. It was a spectacular failure. The botched upgrade locked nearly 1.9 million customers out of their bank accounts, leaving people unable to access their own money for weeks.
How bad can a botched IT upgrade really be for the institution's bottom line? Surely they just roll back the software and apologize.
There is no simple rollback. TSB incurred over £378 million in total costs, which included a massive £48 million fine from UK regulators. The failure highlighted how fragile the digital infrastructure of modern banking truly is.
With all these catastrophic internal tech disasters and clerical errors, why does the media remain so hyperfixated on external hackers and cyber warfare? Hackers provide a compelling villain, But the World Economic Forum reports that 95% of all cybersecurity breaches are fundamentally caused by simple human error. The hacker didn't break through a firewall. An employee simply clicked a bad link or used a weak password. If innocent human error is the root cause of nearly all cybersecurity breaches, what happens when the human inside the bank is acting intentionally, hiding their actions from management? This is the nightmare scenario of people risk, the rogue trader. When an employee with deep knowledge of the bank's internal systems decides to bypass controls to hide losses or chase reckless profits, the damage can be absolute. Can a single rogue employee operating from a branch office really take down a massive, globally established financial institution with centuries of history? Yes. In 1995, rogue trader Nick Leeson single-handedly destroyed Barings Bank, a 233-year-old institution that even held the accounts of the British royal family. By exploiting weak internal controls, he hid $1.4 billion in losses until the bank completely collapsed. After spectacular collapses like Barings Bank, haven't modern regulators forced financial institutions to implement foolproof safety checks to catch these internal failures? Regulators mandated tools like risk and control self-assessments, or RCSAs. Managers are supposed to actively identify vulnerabilities, but in reality, organizations often treat these assessments as tedious, static compliance exercises, just another piece of paperwork to file away before the weekend. Why is treating risk management as a static checkbox exercise so incredibly dangerous for a multi-billion-dollar institution? Because treating risk as a chore creates a false sense of security. A static checklist designed last year cannot catch a dynamic software bug introduced this morning. As we saw with Knight Capital, a checkbox mentality can literally bankrupt a company in under an hour. Even with strict Basel definitions and endless compliance matrices, is there anything major that global regulators are intentionally ignoring?
Yes. While the official Basel definition covers people, processes, systems, and external events, and even includes legal risk, it explicitly excludes strategic and reputational risks. The destruction of a bank's public image is entirely left out of the operational risk capital equation.
Why would the global banking standard deliberately ignore the catastrophic damage of a ruined reputation? A bank runs on trust. If trust vanishes, the bank fails.
Regulators exclude it because it is incredibly difficult to quantify. You cannot easily assign a hard mathematical capital requirement to a PR disaster or a loss of public faith. Operational risk frameworks demand hard data, historical loss records, and predictable models.
If reputational damage is unquantifiable, how do banks calculate the massive amounts of capital they are legally required to hold to survive standard operational failures?
They feed decades of historical loss data, past lawsuits, past system outages, past fines, into complex statistical models. This tells them how much cash to keep in the vault as a buffer. But there is a fatal flaw. Historical data cannot predict unprecedented technological shifts.
As financial institutions rush to replace flawed, tired human workers with flawless artificial intelligence, will the specter of operational risk finally disappear?
Risk never disappears. It only mutates. While AI might eliminate the fat finger typo, it introduces complex black box decision-making. If an AI model hallucinates or makes a biased lending decision at scale, the resulting regulatory fines could eclipse human errors entirely. Wait, if banks are pouring billions of dollars into artificial intelligence specifically to eliminate these catastrophic human errors, isn't this new technology finally making the financial system foolproof?
That is the ultimate illusion. We assume that upgrading from human intuition to algorithmic precision automatically equals safety. But when we actually look at the data regarding technology investments and operational losses, a dark paradox emerges.
If artificial intelligence is supposed to eliminate human error, what is the ultimate truth about technology's role in mitigating operational risk today? Surprisingly, a 10% increase in a bank's AI investments correlates with a 4% rise in operational losses, proving new technology creates as much risk as it solves. While media fixates on hackers, 78% of losses stem from mundane internal failures. Banks must leverage predictive AI while holding enough capital to absorb inevitable human blunders.
If every new technological solution only breeds a new, more complex type of risk,
How can any financial institution truly secure its future against the unknown?
By accepting that operational risk can never be eliminated, only managed. Survival requires moving beyond static checklists. Institutions must marry the foresight of predictive AI with deep capital reserves, acknowledging that as long as humans build the systems, human error will remain the ultimate wildcard.